Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide for chapter 7, the problems for group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problems. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help you if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. All right, so now we left off on problem 50, so we're working on 7-51B in this video. This is on the direct write-off method. Let me get my pen. It says here, on March 31st, King's Tennis Equipment had a $210,000 debit balance in accounts receivable. During April, King's Equipment had the following transactions: sales of $510,000 on credit, so ignore the cost of goods sold. Collections on the account were $525,000, and write-off of uncollectible receivables was $5,000. All right, so why don't I do this? I'm going to draw a T account over here, call this accounts receivable, and it says here had a balance of $210,000 in my accounts receivable. Then in the, let's see, so let me draw an allowance for doubtful account or uncollectible account. Let's see here. So it says assume that to account for it and that there was a $6,300 credit balance. So there's $6,300 in the allowance account. And then let me draw a bad debt expense. Bad debt expense account. Because we're going to need that. All right, so it says here, assume that the King's Equipment used the allowance method to account for uncollectible accounts and that there was $6,300 credit balance in the allowance account on March 31st. That's what we have there. Prepare the journal entries to record sales. Ignore cost of goods sold. So we have to record the sales, the collections on account, and the write-off of uncollectible accounts for the month of April. Next, assuming that the bad debt expense is estimated at 4% of credit sales, prepare the adjusting journal entry to record bad debt expense. Enter the beginning balances and post all of the April activity in T accounts for accounts receivable, allowance for uncollectible accounts, and bad debt expense. Right, so let's see here. So we need to, the first thing that we need to do is prepare the journal entries to record the sales. Right, so our sales were $510,000, all on credit. Okay, so if it's on credit, that's on account. So we're going to debit accounts receivable for the $510,000, and we're going to credit our sales revenue account for $510,000. All right, so we did that one. Okay, now the collections on the account, meaning people paid their accounts receivable. All right, so we debit our cash because we're receiving cash for $525, and we're going to credit the accounts receivable for $525. Right, and then it says and write-offs of uncollectible accounts. Right, well, the write-offs of uncollectible accounts, meaning we know we're not actually going to receive those amounts. All right, and remember, if we're using the allowance method, when we estimate, we're debiting bad debt, and we credit our allowance account, right? So when we actually write off the accounts receivable, we're going to reduce our accounts receivable. So we credit our accounts receivable, in this case, for the amount of $5,000. And the offsetting side, the debit equaling credit, the offsetting is against the allowance account because we already wrote off 2 bad debt in the previous month. So we are going to debit the allowance for uncollectible account. So that's journalizing those. And when we go ahead and post them, right? So let me do this in blue. So when we post to accounts receivable, I have a debit of $510,000. I'm not going to worry about the revenue account. I don't worry about the cash. I have a credit for $525. So that takes care of that one, and that takes care of that one. I have a credit for $5,000, and I have my allowance credit for $5,000. Okay, so that's posting those journal entries to the ledger accounts. And then it says, next, assuming that the bad debt expense is estimated at 4% of credit sales, prepare the adjusting journal entry. Right? So think about what's happening here. We started out with the beginning balances in the accounts. And then during the month, we had our sales transactions. People paid off their accounts receivable, and we determined write-offs. So now we're at the end of the account, and we made the journal entries for those, okay? And we posted them to our general ledger accounts. Now we are at the end of the accounting period, and we want to estimate our allowance for doubtful our allowance for uncollectible accounts. We have to estimate how much is going to be a bad debt by using the allowance method. And it's telling us that we're going to use 4% of credit sales. So our credit sales were $510,000. So $510,000 at 4% gives us $20,400. So that's the amount that we're going to use to write off as our adjusting journal entry. So we'll debit bad debt expense for $20,400, and we'll credit our allowance for uncollectible account for $20,400. Okay, and then when we post that entry, right, we'll post that entry for $20,400 and $20,400. Okay, so now our balances in our accounts, if we add up our accounts receivable, the debits, and we subtract out the credits, we end up with $190,000 for our accounts receivable. For our allowance, again, add up the debits, add up the credits, subtract one from the other, we get $21,700. And our bad debt, we have a balance in the account of $20,400. Okay. So it says here, prepare the adjusting journal entry, enter the beginning balances, and post all the activity, all right, to the accounts. So we did all of that, all right. So that was number one, all right. Here's all of our journal entries. You know, we posted to the ledger accounts, and we calculated the balances in those accounts. All right, so that was number one. And go ahead and pause the video. Or if you haven't written all of this down, so that we can move on to number two, because it says suppose that instead of the allowance method, so we're going to use, we're going to have to rework the problem. So pause the video, write this down, and then start up the video again, and we'll start number two. All right, so back here, and I'm going to erase some of this information, right? it says here, suppose that instead of the allowance method, Kings uses the direct write-off method to account for uncollectible receivables. Prepare journal entries to record sales, collections on account, and write-off of uncollectible accounts for the month of April. All right. Enter the beginning balances and post all the activity and T accounts. So for number one here, right, we went through the process of using the allowance method, okay, and the percent of sales. Right. Now for number two, we're using the direct write-off method. Okay, so it says here, make our journal entries to record our sales. Okay, so that's going to be the same journal entry to record the $510,000. And for the collections on the account, in other words, we're collecting our accounts receivable, that's going to be the same exact journal entry. Okay, but instead of writing off uncollectibles of $5,000 and putting against the allowance like we did before, we're not going to do that. Okay. Why? Because we're directly writing that off, meaning we're saying, okay, our accounts receivable is decreasing, so we're going to credit our accounts receivable for $5,000. But since we're writing it off directly to bad debt expense, we will debit bad debt expense instead for the $5,000. So that's the entry we make to write it off. Right? Then it says enter the beginning balances and post all the activity and T accounts. Right, so we wouldn't have been using, we would not have been using the allowance account if we're using the direct write-off method. We would be using our bad debt expense. So let me fill this in. We started out with a balance of $210,000. We have a journal entry for $510,000, so that's the same. We have a journal entry to accounts receivable for $525,000, that's the same. But now when we do this entry here for our direct write-off, yes, we are going to credit our $5,000 to accounts receivable, but for bad debt, instead of having the $20,400 like we did with the percentage in the previous number one here with the percent of sales method, we have $5,000 as our bad debt expense. So the balance in that account is $5,000. And remember, we're not using this allowance account at all. Okay, we're going to only be using those two accounts. So that's number two. Go ahead and pause the video, and we'll come back and do number three. All right, so hopefully pause the video, wrote all of that down, and that was number two. Now number three. What amount of bad debt expense would King's Equipment report on its April income statement under each of the two methods? Which would better match expenses with revenues, and give your reasoning? All right. Well, that was let me just do it like this instead. Okay, so if you wrote down everything before, okay, this here is the direct write-off, and I'm recreating the allowance account for the percent of sales, right? So this was number one. I'm sorry, this is what the bad debt looks like for number one. And this is the direct write-off method. So we had $20,400 for number one, and that had a balance of $20,400. Okay, so this question is saying what amount, number three says, what amount would the Kings report on their April income statement under each of the two methods? So if they were using the percent of sales method, it would be showing 20,400 as the bad debt. And if it's using direct write-off, it's using 5,000 for the bad debt expense. Now the question says, enter the begin. Oh, I'm sorry. It says which amount better matches expense with revenue, and give your reasoning. So what they're talking about here is the matching principle, right? Which is part of generally accepted accounting practices. Principles, GAAP. Matching principle states that we want to match up our revenues with our expenses, and you try to do that as closely as you possibly can, right? Because you're talking about the operations of the business. So now it's saying, well, which of these two methods better matches up our expenses with our revenues? Because remember, bad debt is an expense. The allowance method better matches, right? Because we're estimating our bad debt based upon our percentage of sales. Remember, so it's the matching principle is matching revenues against your expenses. So even though we're making an estimation of our bad debt, we're making that estimation based upon our sales. So we're using our sales, our revenues, and we're estimating our bad debt, which is an expense in that accounting period. By using the direct write-off method, okay, we're not using sales, we're using accounts receivable, okay? And so therefore, we could have had sales in one period, and we're not writing that expense off until another period, okay? So to give an idea, if in January, we have an accounts receivable for 5,000, it's on our books, okay? Whereas we might write it off in November, right? Well, what that means is in January, we overstated our revenues, right? Because we didn't have a corresponding expense. And in November, right, we're understating, right? Because now we don't have the matching revenue, but we do have the expense that we're writing off in November. Whereas, and that's the direct write-off method. Whereas if we were using the percent of sales method, okay, we had 5,000 in sales in January, and we're taking 4% of it, okay, as an estimate. So we're matching up our 2,000 in expenses with our $5,000 in revenue, okay, and then later on in November, when we say, okay, that accounts receivable is no good, and we'll write off the 5,000. Well, that's affecting our accounts receivable. It has nothing to do with our bad debt, because we had used the allowance account instead of the bad debt expense account. Okay, so that's that's the reasoning why the percent of sales, the allowance method, is matches up better. According to the matching principle, it's more accurate than the direct write-off method. All right, so go ahead and pause the video, and I'll pick up number 4 here, because I have to erase all of this stuff. Okay, so all right, let me get rid of that. Okay, now number 4. It says, what amount of net accounts receivable would King's report on the April 30 balance sheet under each of the two methods? Which amount is more realistic? Give your reasoning. Okay, so remember, on our balance sheet, we show our accounts receivable less our allowance for uncollectible account, which gives us our net accounts receivable. So our accounts receivable under the allowance method is 190,000, and then we have less 21,700 for our allowance, which gives us a net receivable of $168,300. Using the direct write-off method, right, we have 190,000, right, but we don't have any allowance because we don't use that account using the direct write-off method. So our accounts receivable is 190,000. Now, the question says, so that's what our balance sheet would look like if this is direct write-off and this is the allowance. So that's what that section, our net accounts receivable section of the balance sheet would look like. Now it says which amount is more realistic and give your reasoning. Right? Again, the allowance method is more realistic. Why? Because you're taking either your percentage of sales or you're using your accounts receivable, the aging method, to make an estimate in this accounting period. So if this is January, right, and I know I'm not using these numbers again, but let's just say 5,000, all right, well, I'm making, if I'm using the allowance method and I determine 4%, that's $2,200. So I said 2,000 before. Sorry about that. It just dawned on me that that would be 40% of 5,000, not 4%. All right. But anyway, so $200 of that 5,000 is, we're determining that we're estimating that that's going to be bad debt. So our accounts receivable is approximately 4,800. We're matching up the how much we're actually writing off using the allowance account with our accounts receivable. So that gives us a more accurate representation of our accounts receivable. Whereas with the direct write-off method, that 5,000 again in November, right? If we had gone and we had made our sale in January, well, and we're not writing it off until November, then that means that 5,000 in January is overstated again, okay? And then of course our accounts receivable in November is understated, right? So you're not going to know who is exactly when who's going to be good and who's going to be bad. You only know that historically. You figure out a percentage, whichever method you're using, in the allowance method, because that's it may be a rough guesstimate, but it's based upon historical data. Whereas with the direct write-off method, you don't know who actually what accounts receivable is going to actually end up being bad debt, and you don't know when you're going to determine when that will be bad debt. So in the period that the accounts receivable occurs, if you're using the direct write-off method and that one account is bad, you don't know it. Okay, so that messes up the accuracy of your accounts receivable. Whereas using the allowance method, even though you still don't know who's going to be bad or if that account is going to be bad, based upon past history, using the percentage of sale method or the aging method, you can guesstimate how much it actually is going to be, so you have a much better, not a much better, your accounts receivable is more accurate. Even though you still have that 5,000 on it, you're accounting for the possibility, of one of those accounts being bad. Okay, and that's why it's an estimate. So it makes your your net accounts receivable, brings it much more in line. And then because think about it historically, as you don't know which one, but it's a certain percentage. And if it's like always 4%, well, it really doesn't matter which account it is, because historically it's 4% bad. So you can you're talking about an estimate here. You're not talking about an absolutely accurate net accounts receivable. You're talking about an estimate, but it's a better estimate than the direct write-off method because you're taking that into a portion of those accounts receivable spread out spread out over all of them to give you your accounts receivable. Where the direct write-off method, it's at 100%. That whole $5,000, could be bad, and you just don't know it. All right. So I mean, I hope that was clear. Is the difference between the allowance method and direct write-off method. And if you still don't understand, watch the video again, read the textbook, and give an instructor a call, and we'll try to explain it to you, because it's hard to do without creating a whole bunch of data and spreadsheet and stuff like that. But just understanding, looking at each and every section, okay, looking at the balance sheet here, or like in problem in number 3 here, where we did the income statement, right? And we were talking about bad debt. You can get the gist of the idea, which one is more accurate. Basically, the allowance method is more accurate. And honestly, the direct write-off method is only used in the real world for smaller businesses with a limited number of accounts. When you start getting a whole bunch of accounts, generally 30, 50 or more accounts, you have a tendency to use the allowance method instead, because it's just that much more accurate. Right. So with that said, I'm done with 7-51, and I will see you in the next problem for 7-52.